Well, good morning, everyone, and welcome to this very first webinar in our new series called Looking Ahead at Real Estate and Construction, brought to you by BDO in Australia. My name is Reith. I'm BDO's National Real Estate and Construction Leader, and in our webinar today, we'll be discussing real estate and construction in 2022, a macroeconomic outlook. So welcome. Before we kick things off, I'd like to draw your attention to the housekeeping slide. So to start off, you'll automatically be muted, but we'll be accepting questions through the question tab, where you can just post your question throughout the webinar. Hopefully we'll get some time at the end to answer some of those. If we don't have the time, or if we don't get through all of them, we will follow up with you later on. If you're experiencing any technical difficulties, there's a link at the bottom where you can ask for support throughout the session. And finally, this session is being recorded and all registrants will receive a follow-up email containing the slides, a link to the recording, and access to register for future sessions. And obviously the contact details for all of the panel members. So welcome. So at BDO, we often get asked questions like, what challenges and opportunities are you seeing for the real estate and construction industry? Will the boom of the industrial sector continue, or is it a cyclical change? Where will commercial real estate go? What impact has COVID had on the sector? So these are some of the questions we'd like to pose to our webinar panelists today, and hopefully we'll explore these issues and more, and you'll find that helpful. With me on today's panel is Penny Ransom. Penny is the Chief Investment Officer at Investor. Investor is a leading owner and manager and developer of institutional grade real estate in Australia. They are one of Australia's largest and most recognised commercial office real estate companies. Investor have over 11.3 billion in assets under management, with 25 properties owned and or managed throughout Australia. Welcome, Penny. I'm also delighted to welcome Ben Martinery, who's the Head of Real Estate Research at Real Capital Analytics. RCA, or Real Capital Analytics, is a commercial real estate database which has recently been acquired by MSCI, a leading provider of critical decision support tools and services for the global investment community. BDO are a subscriber and we get a lot of value from the database and from having chats with Ben on a regular basis. Thanks, Ben. I'm also joined by Sebastian Stevens, BDO in Australia's National Leader of Private Equity and Corporate Finance Partner. He's also the author of the annual BDO A-REIT survey. For those who missed it, BDO's 27th annual survey of A-REITs is available now on BDO's website, and it explores the strong rebound of the A-REIT sector in the 2021 financial results. Welcome everyone, and thank you for joining us today. So looking at an overall overview, let's ask our panelists a couple of questions. We've seen resilience and rebound as terms being used in our A-REIT survey to describe the performance of the sector, and we anticipate strong growth in 2022. Ben, according to RCA, real estate transaction volumes reached an all-time high in Australia at about $71 billion. Can you talk us through some of the factors contributing to these record transaction volumes?
Absolutely, yes, and thanks for having me and welcome everybody. Yeah, 2021 was it was more than a bounce back on 2020 levels. As you said, we did have a record year of around $72 billion. And I'm sure it'll come as no surprise to many that industrial was the leading driver of this outperformance. There's so many large portfolio deals that happened last year. Look at Milestone, the Milestone deal at $3.8 billion, Australia's largest ever direct deal. Blackstone 5, Blackstone picking up a share in Dexus, Australia Logistics Trust. There were so many portfolio acquisitions in the industrial space. On average, over the last 15 years, actually, portfolios have only accounted for about 12% of any and in a given year, but last year they actually accounted for 25%, which is by far and away a record level. So really, the industrial really was a driving factor behind the outperformance in 2021. That's not to mean that the other core sectors were sat on their hands. There was a lot of activity in the office space, despite the persistent uncertainty around the future of the office that it has in the workforce in the coming years. And for me, everybody's talking about industrial, and that grabs all the headline, you know, the year of the mega deal, etc. But for me, retail was the standout performer last year. Considering the struggles retail have had, obviously as a result of COVID with widespread lockdowns and non-essential retail services being shut down, the fact that over $18 billion was still spent on acquiring retail assets is for me, it's quite a remarkable thing. And that was about 140% increase on 2020 levels. But the problem I find with comparing stuff to 2020 is you're comparing, you know, volumes to a once in a 100-year pandemic and, you know, a black swan event. So the numbers are always going to look really, really large. But for me, the interesting thing about retail is that it was actually 12% above the 5-year pre-COVID averages. Considering all the troubles retail had before COVID, again, it's quite surprising that it had such a strong year. And Australia is a bit of an outlier in that sense, because for most of our other comparable markets, US, Germany, France, the UK, for example, yes, some of those markets saw a bounce back on 2020 levels, but none of them saw a bounce back on those pre-COVID 5-year averages. So Australia is a bit of an outlier there. And for me, that was a real interesting part of what happened last year.
And Ben, in our earlier conversation, you'd mentioned that the interesting part is that it's not the mega stores, the big shopping centres. It's really the local and other centres that are doing well.
Yeah, absolutely. The way the year kind of developed last year was fascinating as well. You had a lot of the smaller deals were done at the start of the year. And yeah, they're the grocery anchored shopping centres, because a lot of us were forced to stay within 5 kilometres of our home or within our LGA. So we couldn't go and visit the larger shopping centres to go to a bigger Coles or a bigger Woolies. We had to visit the neighbourhood shopping centres. And of course, investors saw that and saw, okay, these, the turnover rents are increasing, the value of these assets are increasing. So they piled into those neighbourhood shopping centres, and they really were one of the best performing asset classes last year, and indeed over this entire COVID period. But as the year started to develop, we started to see a bit more activity in the larger end of town, even in sub-regional assets, which before COVID, nobody was touching, because of the troubles that the DDSs, the discount department stores, had been having. A lot of investors were shying away from the sub-regional shopping centres. But last year, again, we saw a boom in sub-regional activity. I think it was a record year. It certainly beat 3-year and 5-year averages. And investors appear to be following those population trends as well. A lot of people are leaving the capital cities, moving out to more regional locations. So investors have followed that population and picked up sub-regional assets there, because obviously population growth will drive retail sales. And the other part of sub-regionals is they're big plots of land too. And if you have a development play in mind, you think you might redevelop this thing, while you're still formulating those plans, you've got a stable, steady income stream coming in. And if you develop a plan where you're going to say, right, we need to carve off a little bit of this asset for residential because there's so much population, we can do that as well. So I think there's a lot of fascinating things happening in the retail sector. And of course, towards the end of the year, we had 2 large super regional shopping centers sell as well, which again it's a little bit unheard of across the rest of the world.
No, thanks for those insights, Ben. Penny, from your experience at Investor, can you mirror some of those comments or add your own?
Yeah, thank you. Absolutely. Look, for us, that we're really seeing it's the weight of capital. So the sort of superannuation funds, government pension, and other government funds around the world have been consistently under allocated to real estate. The latest ANREV surveys come out, and there's about sort of an 8%, nearly 9% allocation to real estate, whereas they're targeting in excess of around 10 or in excess of 10. So I think that as a global theme is true, and also the inflows of money going into those vehicles and those institutional investors is also running at a much faster pace than the availability of stock to get that money invested. So that's what they call the sort of global weight of capital thematic. So that's absolutely true. What I would say is that Asia Pacific's been getting a really strong relative bite of that weight of capital over the last few years, probably the last decade. And that's where the global capital has been really under-allocated to Asia Pacific historically. But now, as they've got more and more comfortable with the quality of investing into the various countries, and also strong population growth and economic growth, which comes through a lot of the Asian countries, you're seeing that desire to actually have a good piece of their global portfolios allocated into Asia Pacific. And then when Australia sits into that, Australia is one of probably only 3 core markets, or probably 4 core markets: Singapore, Hong Kong, Japan and Australia. The other markets can be quite hard to get into as well. So in terms of a target, Australia is getting a bigger lion's share, and we've seen that historically in terms of our the global appetite that's been coming into the country. So at the same time, we've got local superannuation funds that are also growing in terms of allocation. So that's really the driving force behind money wanting to come into the sector over the last few years, and I think Australia's really done well as a result of that. We've done some really big deals with new partners over the last sort of 18 months. We announced at the end of last week Link transacting a very large portfolio of ours. We've got an investment of just over 1.3 billion into office, which was announced on Thursday, Friday. And we also at the end of last year closed for Mitsubishi Estate to come into an office development at the end of last year, and Manulife coming into an office development at the beginning of last year. So even though the pandemic's been there, this capital is looking for really high quality investment in Australia, and so the pandemic hasn't stopped that money chasing after, you know, prime quality assets here in Australia.
So it's interesting to hear that the border closures, which are set to open, hasn't really had that big an impact on foreign investors. Do you see that changing when borders open back up again? Penny, if you can continue to talk to that.
Yeah, well, what I'd say is it's for the traditional sectors. I don't think it's been a concern, and the offshore money has been partnering with local advisors to be their eyes and ears on the ground while doing due diligence. Where it potentially has had a bit of an impact is in the new sectors and alternative sectors. And when I say new sectors, build to rent, we've established a build to rent platform, and we are working with potential investors to come in alongside Oxford in the execution of that strategy, which is about a $5 billion develop to core strategy that we're undertaking at the moment. And capital does want to come out. They want to see the sites. They want to understand the product. They know it's an emerging sector. And that's where I think, once the borders open up, we're going to start to see the capital really flow even more into that sector. And it's actually flowing okay. And we've seen some announcements in the last 12 months of big institutional investors partnering with local expertise on the ground to do build to rent, but it's sort of a project here and a project there. I really believe that once the borders open up, you're going to see that really start to take off, which is really in line with, again, the ANREV survey, which came out of global investors for the year ahead for 2022, has focused right in on industrial and residential being the 2 key sectors there for that global capital.
Ben, anything to add on the border closures, what you're seeing in your data?
Yeah, definitely. With overseas investors, there really was a sort of flight to quality, flight to core. The top 4 markets for overseas investment were Sydney office, Sydney industrial, Melbourne office, Melbourne industrial. So you really can see that pattern emerging there. And offshore investors, they really did decrease their allocation to the rest of Australia, and then they subsequently increased it quite considerably to Sydney and Melbourne, which is the complete opposite of what we saw with domestic investors. Domestic investors increased their allocations to the rest of Australia by about 60% compared to pre-COVID averages, but they decreased their allocation to Sydney and Melbourne. And I think, as Penny rightly said, without boots on the ground, it's pretty hard to move out to regional areas and look at some of these assets that you have to do a bit more than just kick the tires for. But investing in a strong industrial portfolio, no problem. Investing in a premium Sydney office tower, no problem. Investing in alternatives, build to rent, classic example, it's a little trickier without local knowledge. So I think once the borders open, it'll be interesting to see if this is more of a cyclical change, more of a structural change for domestic investors looking outside of major markets, and if offshore investors start to follow suit. Because there's a lot of discussion at the moment about what is just a cyclical change as a result of COVID and what's a real structural change. So it remains to be seen whether that is one, but certainly in this time of investors chasing yield, following populations, we might start to see increased investment from offshore parties into more regional areas once those borders open.
interesting. Seb, do you want to add any comments to that?
Look, I mean, I think they've covered a lot of that ground. I think one of the things we are seeing is that our international clients and international funds, pension funds and private equity, really like this region, that they like how well managed the Australian property market is. I think it's fantastic A-REIT managers, etc., out there, and they see that as really lessening the blow in moving into a foreign jurisdiction. I think what we're also seeing is that obviously technology is flying at the moment in terms of deal volumes, but if you look at property and how well managed it is, how secure some of those cash flows are, I think they're pretty underweight in terms of investment. And I think Penny mentioned that earlier. I think that's a really important thing, because a lot of the technology growth is not necessarily backed by cash flow. And I think that the reallocation to property, especially if it's rebounding, we're going to see more of that. In terms of transaction volumes, what we're seeing is typical for Australian REITs is that they are eking out every last return they can get, so consolidating and trying to get those economies of scale and things like that. We're seeing a lot of restructures, etc. So it's a dynamic, well managed part of the market, and I think these guys have just shown that there's continued investment regardless of COVID.
Yeah, no thanks. So we've touched on a number of broad areas, and it's fascinating to see the insights there. Let's delve into the industrial sector in a bit more detail. It's obviously boomed. Ben, I think some of the data that I've read from your publications are that the industrial market share on average was 23%, and it's now about 43% of the market share, a significant uplift. And talking to you, you said, where's the end to it? Where's the peak? Have we reached it, or is there an end in sight to that growth? Where do you see this going? Is it a boom that's going to continue, or have we reached it?
Oh, it's a really tricky one. I think I said on a couple of occasions last year that surely now we've hit peak volumes. You see large opportunistic companies getting out of the sector, and then they drop another 2 billion on getting back into the sector. So it's really hard to work out when this boom is going to end. I think the thing with industrial is it's not just COVID driven though. Industrial was really a hot topic before COVID started, and COVID has just accelerated and exacerbated that trend. And I think obviously that the retail sector is a big part of that too, with online distribution warehouses, cropping up left, right, and centre. So retail is playing a big role in the industrial boom. When it ends, I mean, it's anybody's guess. Pricing is getting extremely tight. We're seeing some of these assets trade at 3.25%, 3.5%. This is some pretty tight pricing. But there is a lot of discussion that this is simply where industrial should sit. It's like, well, that's obviously a fair opinion. I mean, most property sectors start off as a little bit alternative, and then over the next 10, 15 years, you get more institutional investment into them. They start to become more institutionalized, and then they kind of find their level. Whether that means industrial yields are going to sit below office and retail, I guess that remains to be seen. But just looking at our numbers, there's no shortage of appetite for the industrial sector. We still have another $1 billion or so worth of deals that are awaiting settlement from last year, and there's another $1 billion or so that have transacted in Q1 this year. So the appetite is just there, and at the moment I can't see it slowing down anytime soon. And this is not just an Australian thing, this is a global thing. I mean, industrial volumes are absolutely killing it all over the world. So it's obviously there's a finite supply of industrial, so investors are trying to get into it. And of course, I always say the best way to build scale is to not build scale, it's to buy scale, which is why we've seen so many large portfolios transact. How many more of those are left to transact? I guess that'll determine how much of a slowdown we see in the industrial space over the next couple of years.
Okay. So it's interesting that you say that the last 2 years have been an accelerator rather than a change per se. Obviously, we've had supply chain issues, toilet paper, the obvious one, but all throughout we've had containers waiting in China to be uploaded and out here to be unloaded. We've had those sorts of issues over the last 2 years, but that's the accelerator part. Companies going to just-in-case warehousing, which is increased warehousing. You're saying that's just an accelerator per se. It's always going to be growing.
Yeah, I don't think anybody could have predicted the levels that we saw. I certainly wouldn't have predicted at the end of 2019 that industrial would be the #1 sector in 2020 and then the #1 sector in 2021, 2 record years. No one would have predicted that, but we certainly saw that industrial was becoming a hot topic. There was a lot more investment into the sector, but like I said, COVID certainly has accelerated that and exacerbated that. But it's, again, it comes back to this: what's a structural shift and what's a cyclical shift? I think industrial, it was a structural shift, but it started before COVID. And again, COVID just merely accelerated that trend. And of course, the obvious one is that we all had to shop online for most things. So you need more distribution warehouses. And indeed, we need more last mile distribution warehouses in Australia. And that certainly was a growing trend well before COVID, that we need these types of distribution warehouses. And it's not just in the actual transaction volumes that we're seeing so much appetite for industrial investment. The #1, I think industrial has more properties under development than any other sector. Kind of makes sense, of course. You know, offices, you don't have that many, you just have big ones, so they account for most of the value. But there's a heap of industrial and construction as well to kind of mitigate that. I guess there's a slight supply-demand imbalance at the moment for industrial.
So where does Ben, continuing on with you, where do you see the future? Obviously, pricing is a limiting factor that you say, so it's going to run out. But what other limitations are there, in terms of, is Australia going to run out of room to put these sheds? What are are we going to see white vans on our, in our traffic jams? What is the limitation to the industrial sector?
It's always a funny one talking about supply for industrial, and particularly with offshore investors. They go, but Australia's huge, you've got plenty of space. It's like, yeah, we do, but it's not necessarily serviceable land. It hasn't been serviced yet. We still need electricity, we still need water, we still need roads, we still need all that stuff to actually develop these big plots of land. And that's obviously happening out in, say, Western Sydney, for example, around Badgerys Creek with the new airport there. There's obviously a lot of activity in that space. But in and around our ports, like Port of Melbourne, Port Botany, for example, there's no space there anymore. It's all been taken up. So we're starting to see more multi-story warehousing come out of the ground, or come out of the roof, I suppose you could say, where, because your land's constrained on either side, people are building up. So I do think actual serviceable land is going to be a bit of an impediment in the short term. I think the other thing, obviously, is rent growth. The industrial sector hasn't seen a lot of rental growth. And part of the reason for that is, of course, you need a supply-demand imbalance in order to push rents. Rarely is there a supply-demand imbalance for industrial, because you can build a shed in 3 to 6 months. It's a lot quicker than having to build an office, for example, which will take you 3 years. So it depends where rents go as well. And I have seen various forecasts that say rents are going to increase over the next few years. Obviously, inflation is going to strip a little bit of that out. So I think when you're trading assets at 3.25, 3.5, you really want that rent growth story to come true. Otherwise, these assets become quite pricey, and certainly when you try to sell them on, it becomes a bit difficult. So I do think pricing and supply of land might be a bit of a constraint for the sector in the next coming years.
Okay. It's interesting that you talk about the multi-story warehousing. We have a number of clients at BDO that service the black warehouse, the dark warehouse, where they provide technology solutions for multi-story. And these are really high towers that we've seen all being automated and run by robots. So that could be a way of the future as well, just add a lot of automation to it.
Absolutely. I think dark warehouses are quite fascinating. I suppose most people wouldn't know. I certainly didn't know that when you order something online, there's a little robot that gets the order at this dark warehouse. It goes, shifts along the ground, goes up, picks it up, takes it down, and takes it to a loading dock, packages it or whatever, puts a label on it, and then either puts it onto a van, which is still driven by a person. I guess that may change over the next decade or so, or a drone, Amazon, for example. But certainly industrial assets, they're kind of moving away from it's just a shed with a few people in them. Now they're high tech, and that of course means they're extremely valuable, which again is a justification for charging such high prices for these things. They're so full of technology that is extraordinarily valuable.
Excellent. Now we could talk on industrial for a lot longer, but I do want to get on to commercial real estate as well. And Penny, this is an area that you play in largely. Obviously, real estate sector has also grown. I think 2021, 22 billion in deals with foreign buyers, accounting for a large portion of these deals. We thought that COVID was going to mean the loss of office space. We're all working from home now. There's no need to go back ever. I know from myself, after 2 years of various lockdowns, I can't wait to go back to the office, and I'm now spending 2 or 3 days a week back in the office, and it's a great feeling. Penny, what are you seeing at Investor as landlord, and what's your suggestion what the future could look like?
Yeah, I think it's fair to say personally I'm in the same bucket in that, you know, second time lockdown came around, I think everyone's gone, oh no, actually I don't really want to do this again. And the, you know, the mental health challenges with that, the efficiency challenges, team morale, and then ultimately impact on culture. So good cultures can withstand that for a period of time. And I'd say at Investor, we've got really strong culture. So the first lockdown, our culture carried us through. That was, you know, it was all a bit of a novelty. By the second lockdown, it was, we've got new starters in the business. They're not getting to understand how we work and to understand how our culture works. They're not learning, our young ones are not learning and seeing their behaviours being exhibited. People are dying to come back in to all get together to communicate where human beings are naturally, you know, wanting to be part of a community. It's who we are in our makeup. So I think definitely, you know, 2 years on, I think organisations have had a time to strategise on their space needs and to think about, actually, we do want to, you know, really invest in our workplace. You know, we want to encourage our staff to come back so that we can get more efficient, we can get more idea creation going on. And I think as a result, you know, we've seen a notable pickup in inquiry. We've got 2 overstation developments in Sydney currently available for lease, and that's in 39 Martin Place and the one above the new Pitt Street station. So all up about 80,000 square metres. We're also due to kickstart a new development soon in Brisbane. And again, you know, significant commitment to new space. We're feeling really positive about that because it's a flight to quality that we're absolutely seeing. So tenants are wanting to, and we saw some announcements in the press today from Dexus about Brisbane as well. Tenants are wanting to commit to reinvigorating their workplaces, and they're going to want to do that through best-in-class assets. So, you know, we really, you know, believe that assets that have high quality, strong amenity, strong technology focus, and of course ESG credentials. And interestingly, this has been driven not just by the tenants, but also by the investors, that on the basis that you're focusing on that kind of product in the really strong locations, then, you know, it will be a successful investment going forward. And look, space availability in office assets that are less than 10 years old in all our core CBDs is pretty limited. I think that's a really strong example.
Yeah. Seb, being a tenant at BDO, can you echo some of those thoughts as to what the company's been feeling over the last 2 years?
Yeah, look, I think exactly what Penny was saying. I think, you know, culture can only withstand, you know, they work from home for so long. I do think there'll be a permanent shift to a sort of a combination or a hybrid, but I think that, you know, it'll be on your terms. Obviously, you can come into the office when you feel like it and stay home when you feel like it. So I think, you know, we're in the same process now of looking at what are our needs. You know, when you come into the office, it's now a destination piece. It's a collaboration place. It's, you know, if you're just going to sit there and review a file, you can do that from home. So I think it will change the fit out and the way we work. And we're looking at that now because, you know, obviously we want to make sure we make changes that are for the long term. So yeah, I think that's going to be a critical part. And I think that's hopefully going to help the office sector because, you know, you necessarily need more space if you're going to collaborate and if we're going to be in a, you know, potentially ongoing, dare I say it, COVID environment where you will need space. And as a result, you know, sort of shrinking desk sizes, etc., that was happening beforehand, probably not going to happen going forward. But yeah, it's to be seen, I suppose. So yeah, interesting times.
Ben, are you seeing similar comments through the data that you're collecting?
Yeah, definitely. I think the death of the office sector was definitely prematurely supported. I think the office sector has a definite role to play, certainly. As Penny mentioned, particularly for the younger generation, because if they're not in an office, they're not exposed to people, more senior people. You don't get those water cooler moments. You don't just overhear conversations where you start to learn and you develop in yourself. And I think there's a danger that is lost with the next generation of workers. So I think businesses are fully aware of this and they're definitely encouraging people to come back. In terms of numbers, 2021 was a bit of a strange one. office volumes did obviously bounce back on 2020. That's to be expected. They were still a little behind pre-COVID averages, but I think that was more of a timing issue. So generally we see that Q4 is an enormous quarter for office deals. You start the process in January and it takes a good 9 to 12 months to settle. So Q4 generally accounts for around 39–40% of office transactions. That didn't happen this year, but we have about $3.3 billion worth of office deals awaiting settlement from 2021. And I think it's just taking a little bit longer to get your DD done, to dot your I's and cross your T's and get these past the investment committees and stuff. And that's kind of delayed a little bit of the office bounce back, but it definitely has bounced back. So much so I would assume that Q1 is likely to be a record level of investment for office volumes, just looking at what we have in our awaiting settlement category, purely because, again, from the hangover effect from 2021, but also there's some big deals that have been announced this year already as well. And I don't think people dropping $22 billion on the office sector is testament to the office sector is dead. It's certainly not. That's a lot of money to spend on the office sector. And no astute investor is going to do that if they think that the sector doesn't have a future.
That's good to hear. I'm just wondering with vacancy rates is probably, it's a lag indicator because you're not actually going to vacate your premises immediately as COVID hits or as lockdown hits. So that's probably not the right indicator. Actually the question I wanted to ask was around how could we incentivize, how do landlords incentivize tenants to come back in? How do we, what are we seeing in the marketplace? Penny, do you have a view as to what Investor is doing to make it interesting for people to come back into the office?
Yeah, look, we have a sort of technology platform that enables us to communicate with the tenants in our buildings. So we are constantly in communication with everyone, and it's just those enhanced ability to collaborate and to do things together, to be involved in causes that are important to them, and really investing in our buildings. We've invested a lot in our buildings in terms of the amenity spaces, wellness spaces, and also just those environments that are really pleasant to work. So additional space. So if in your office you need to get some other space, you can go to other places within the building and have those opportunities. And I think, again, people wanting to get out of that home environment of that same everyday Groundhog Day kind of experience, making sure that you're providing them the building and the amenity and making it more of a destination to attract people. So it's that focusing on investing in the assets to make sure that they're offering more than just a roof over your head is really important. It's not
just a workspace, it's a community space. People want to come into town to catch up with people, and it's interesting to hear that it's not just on the employer to create that space, is actually the landlord as well helping to create that holistically for the environment. Yes. That's good.
Yeah, definitely.
So Ben, where do you think commercial will go in next year or two? It's what's your forecast?
I'm not allowed to forecast these kinds of things anymore. It's like offering investment advice. It's frowned upon. I'm not allowed to do that.
Okay, right, okay.
But I think just looking at what trends we've seen, and certainly what we have in the pipeline, is that I can't foresee that the investment in the office sector is going to slow down anytime soon. There's just so much appetite out there. There's a massive weight of capital, and arguably during these uncertain times, properties where investors want to invest because they know they get a stable, steady income stream. And that's really what the crux of property investment is. It's not as volatile as a lot of asset classes you can invest in. So I don't see property investment slowing down. Again, just looking at our numbers, what we have in the pipeline already, it's about $7 billion for this quarter. Last year, the same quarter last year was around $10 billion. So we're only halfway through this quarter and we're already looking likely to surpass those levels. So I think we'll continue on this current trajectory that we've had. Whether or not we have 2 record-breaking years in a row, again, it's pretty hard to predict in these uncertain times. I don't know what's around the corner. But just touching upon what Penny said, there's just such a weight of capital that's wanting to find a home in Australian real estate, particularly from the APAC market. And I don't see that changing anytime soon.
And as someone said earlier, with the borders opening up, you'll probably see some more of that investment being attracted into Australia, where people can actually come in and knock on a door somewhere and actually look at it. So maybe that'll increase as well.
Yeah, I can imagine that will certainly increase. Yeah, increase volumes for this year.
Okay. So because office space and the future of office space is such a big topic, we've actually decided to put a whole webinar together for the future of office, and that'll be run in April. We'll provide further details later on, but yeah, we'll focus just on that aspect, and we'll get a couple of other speakers to put in their views on that. It's certainly an interesting topic. But looking at the investment landscape across all sectors again, we haven't really touched on alternative asset classes as much. Ben, you spoke about, we've spoken about Penny, build to rent, other alternative investment classes that are going to be up and coming. Maybe Penny, you can describe what are you seeing as what are the up and coming alternative classes that we may not have touched on yet?
Yeah, look, I think the build to rent is a really important one, and that's just because Australia screens, you know, so positively on all the fundamentals that drive that, whether it's you know, the housing affordability issues that we've got, above average population growth that we experience, and we ride some of that from Asia as well on our immigration, bad private rental experience that you have that we've all had at some point in our life. And just the fact we're a really strong and attractive investment market. So I think that's where residential as an alternative is going to really be taking off. What's interesting, if you look at the main markets over in the US and the UK, it's actually not an alternative. It's one of the core sectors, and in fact, one of the most favoured core sectors. So it's alternative for us at the moment because it's establishing, but I think very quickly it will become a core part of it and a core fabric of our investment market. I think other areas where you're just seeing it's just where there's the global thematics, and if you think about, you know, healthcare, there's been a lot of money pouring into healthcare, and that's really the thematic around ageing population, and an increased focus on people on their own wellness. The data centres, that's one we didn't really touch on when we were talking about industrial. I mean, the amount of data that needs to be stored is phenomenal, and needing to be stored in locations that are not out in the middle of Central Australia, for example. And so building facilities that can house that data storage is going to be very strong. You know, and then what other ones are there? Probably the more just investment going into infrastructure and those sorts of areas as well. I think on the residential side, I think you're going to see a lot more coming through also just in social housing, so and defence housing. So you've seen, and which we typically again haven't done much of that in Australia, but in the US and the UK, very much a PPP style model, and we've just seen you know, defence RFP go out for over 1,000 units here in Australia, in Sydney, I should say, and a social housing one likely to come in the not too distant future for around Redfern to replace all of that. So again, the government would prefer to do that in a PPP style arrangement with institutional investors getting in amongst that and funding that. So I think you're going to see a lot of focus on that as well.
Ben, you actually called 2021 the year of the alternative investment, I think, somewhere.
Probably.
Yeah. What are your views on that?
Yeah, look, there's so much activity in that alternative space, and as Penny says, it's always tricky calling something an alternative because for some markets and some companies that just is their bread and butter, particularly on the multifamily or build to rent side. Interestingly, we only lag kind of two major markets in terms of how we've compared to pre-COVID averages, and that's the US and Germany. But if you look at their core market breakdown, they actually lagged us quite considerably. The only reason they outperformed pre-COVID averages was because of the sheer volume of money that went into multifamily. And a big reason for that is, of course, multifamily really is one of the most stable asset classes in property. But we just don't have that sector here. It's a very nascent sector down here. So I think that certainly is going to start to develop over the next few years. In terms of other alternative assets, I think in 2020 and 2021, we've basically had a record year for all the alternative assets we covered: childcare, medical office, pubs, service stations, data centers, student housing, self-storage, the list goes on. There's various reasons for each asset type. I'll just touch upon a couple other ones. Penny's already covered healthcare. Obviously, it's an easy one. Childcare is another one, which is quite an interesting one. People keep saying to me, oh yeah, you see investors moving up the yield curve. It's like, well, childcare, they're pretty tight yields. You know, we've seen some 3s, 3.5s for childcare assets, but It's the long leases that are built into childcare, you know, the 10, 15-year leases with a 5% upward rent review, for example. That's the kind of income stability you want in these most turbulent of times. Service stations is a fairly straightforward one as well. It's really tapping into that convenience retail aspect as well. Again, talking about those grocery anchored neighborhood shopping centers, a similar kind of thing if there's a little supermarket attached to the service station, another big reason to get into that sector. Self-storage is also one of my favorite ones. We even saw Blackstone spending 400 odd million on a portfolio last year. Self-storage, again, we've all been forced to work from home for an extended period of time, and we've realized that second bedroom doesn't really accommodate 2 people as a home office, so maybe we need to start moving the bed out, the couch out, and we got to store it somewhere. So self-storage places are full, particularly where every time I go to self-storage places to find out, you know, what's going on. You guys seeing a lot of activities? Yep, full, waiting list full, everything's full. And there's a heap in the development pipeline as well. So again, that's one of those, you know, is this a cyclical, is this a structural shift in this move to alternative assets? I think it's a bit of both. I think it depends on the asset class. Pubs is always, I've always talked as pubs as the alternative store walk, because it's always, you know, $1 billion, $1.5 billion worth of activity in that sector. And of course, we had Charter Hall picking up ALE last year. So I think personally, alternatives are probably here to stay, and some of them will have to stop calling alternative.
Yeah, fascinating. Seb, any comments on that? Any final comments on the investment landscape?
No, echoing that, I think, I mean, whether you call them alternatives or specialized areas, I mean, that's, you're seeing that's what, 50% of the US REIT market? I don't know. It's a big number over there, and probably not quite as dominant here in Australia, but it's where you can actually get people who've got that management expertise, finding sort of unloved assets and really making a gain. As it gets into maturity, you know, it's diminishing marginal returns in terms of what you can find. But I can see that just continuing to grow, because I think Ben and Penny have both mentioned it, but you know, those stable income streams, you know, that property gives you, and long-term cash flows like that is going to be becoming, I think, more and more important going forward. I do a lot in technology, so I love technology, but at the same time, there are going to be some failures there, because things don't necessarily turn around to actually make cash flows, whereas property is that more secure asset. And the fact that they're so well run over here, I think, you know, I've worked with the REIT market for over 20 years, and you know, these are very impressive individuals who run these businesses, and they know what they're doing, and they eke out every last return you can get. So yeah, I see most sectors doing well, but I see that there's what I call specialized sector really increasing over the next couple of years.
No, good. Thanks, Seb. And then Penny, maybe a final comment from you. Just generally, what are you seeing as being maybe a generic investment mandate that real estate companies should be looking out for as we head into 2022?
Yeah, look, I think across all sectors, whether it's alternatives or the core sectors that we're used to, it's quality. I say quality, and that comes, you know, down to quality of the build, quality of the amenity, and the location. Just really, no matter what sector you're looking at, I think you can't miss that. And then when, you know, you've got the asset in the right spot and the whole bit, that's the latest generation. It's probably 2 things. It's staying close to what the capital's looking for. So really understanding what that capital is, where it's wanting to place its money. And then secondly, staying really close to the demand fundamentals. So, you know, if it's industrial, it's around e-commerce and connectivity. If it's retail, it's experiential. If it's office, it's spaces that enable collaboration and a destination. If it's build to rent, it's about, you know, providing community and affordability. And so again, I think it's just saying, well, what are the really important demand pieces for each of the sectors you're looking at, and then where is the capital wanting to place its money in terms of location and scale. And if you marry those 2 together and you focus on quality, I don't think you can go wrong. Okay.
Thanks, Penny. Just asking the audience for questions, if you can just jot them down in that those comments. But Ben, any final comments from you for today?
No, I think we've covered everything. I certainly agree with Penny that quality really does stand out, and we've certainly seen that with overseas investors. They are looking for quality assets as it stands in those core markets. But to try and squeeze the most out of those returns, we are seeing investors really having to look to drill down into perhaps more specific markets and more specific asset types. You can't just jump to core, you can't just jump, flip between office, retail, industrial, because they're all kind of yielding around similar levels at the moment. You can't just jump up the yield curve and pick in a retail or industrial at the moment because of the trading. So I think we might start to see a bit more push out into sort of non-core markets. I know the Gold Coast had an extremely good year last year, driven obviously by Pacific Fair, but also the industrial sector up there was quite good, as well as the office sector. And again, it's following population trends as well. So I think the next few years are going to be a bit more interesting than perhaps pre-COVID years. I think we'll start to see some more interesting investments and move some of these alternative investments into a bit more core. Same for alternative locations. They're going to become a bit more core as well, I think.
Okay. So we do have some questions coming in now. So might just run to those. So Penny, maybe for you, it's a build to rent question. It's really a time frame question around when do you think it'll become more mainstream in Australia? It's
I think the challenge is because it doesn't exist here, we're having to develop it and construct it. So it's going to take a couple of years, and it's amazing how long lead time some of these things. We're looking at sites now, and it could be 3 years until we're hitting PC because of the planning and then the design phase and then the construction phase. So it's just, I think it'll become core once we've got a lot of operational stock really happening. And also as a result of that, the rental market understands the product, how it's differentiated, how it's different from private renting, etc. So I would say, I think at least give it probably 5 years before it's going to be mainstream. And interestingly, just as a bit of an anecdote, a lot of the Australian super funds, there are a couple that are open to dabbling in it here in Australia, but they're typically wanting to go into established markets where there's established product first. So you're seeing the big Australian super funds that want to go into build to rent doing it in the UK and the USA and Canada and through the Europe. And then once the sector here has a lot of operational product, then I think you'll see them starting to invest in the home market, but they're not wanting to go up the risk curve quite so high here in Australia at the moment. So it's really a lot more offshore pension money that's already experienced build to rent significantly in the UK and the US that's coming here to get ahead of the curve and get involved in it, such as Oxford, Ivanhoe, Cambridge, GIC, APG. They're all the names that are sort of backing it here in Australia at the moment.
Interesting. Okay, that makes a lot of sense. Okay. Now we haven't spoken much about residential, and one of the questions here is very specific. It's about modular and prefab housing. Do you think maybe we ask Ben, but Penny, jump on in. Ben, do you think it'll become a trend, a construction trend, to build residential in prefab?
I don't know. Not an expert on prefabs. I imagine as people, supply chains are getting squeezed and margins are getting squeezed as well, that you'll start to see that kind of a way of making those margins sing a bit more. And I guess in affordable housing is probably one of the easier ways to get into that for sure. But yeah, I'm not entirely sure on that one.
No, sure.
I can jump in on that. I think that what we're seeing in the US, especially on that modular prefab housing and in actually parts of Europe, it's really taking off because the cost of building has gone up considerably. And the technology now is actually producing really impressive product for a far lower cost. So I know we've been talking to businesses who are looking to bring that into Australia. I see that as a really important part of the process because housing affordability is a real issue. And if there's a way of actually doing it more cost effectively, obviously that's what we'd do. But Penny, you were going to say something.
I'm really just echoing what you both said, because you both focused on cost and margins, and land values. Land values in our core cities are still really expensive. So in order to try and counter that, any way of reducing costs and improving your margins is key. So I wouldn't be surprised if, especially if the technology is there and the quality of the end product is there, that it wouldn't be embraced more as a thematic.
No, interesting. Yep, that makes sense. Okay, I can't see any more questions come through, but look, we might close it there unless there's any final comments from Ben or Penny. But I think we've covered a lot of ground today. We went from just a generic overview as to where the macroeconomic factors are lying. We went into a bit of a dive on logistics, commercial property, and the future of office. And then just closing out with alternative asset classes. We did touch a bit on retail. Thanks, Ben, at the start for expounding a bit on that topic as well. So I think all around a fascinating discussion. Thank you very much to Penny and Ben and Seb. Very informative session, and I hope the audience got a lot out of that today. So that brings us to the end of this session, and what you'll see now on the screen is just information on our next couple of sessions. We have planned all this out for the rest of the year. Looks like an exciting series of webinars. The future of office space, as I've mentioned. ESG is a massive topic, but we'll look at how that impacts on real estate and construction. We'll have a separate topic just on build to rent and funding. How do we fund for real estate and construction? And then we'll have a wrap up at the end of the year in November, hopefully coinciding with Seb's A-REIT survey being launched again. And so that rounds out the year. So we'll send out details of the webinar series in an email to everyone that's attended today. We would appreciate, before we close the session, if you could fill out a short feedback survey. I think it'll launch once you close the webinar, and it'll just help us improve future webinars. So thank you for attending to that. So on that note, thanks again to our speaking panel, Seb, Ben, and Penny. And thanks again to the audience. Thanks for attending, and we look forward to seeing you again at our next session. Thank you.
Thanks, guys.
Bye.
Bye.